So today's video, we're going to talk about the top 5 issues for 2024. First, we'll do a year in review from the top 5 issues in no particular order. The first one was inflation and interest rates. The second one was the price of money. The third one was corporate profits. The fourth being unemployment, which was at 3.7. And the fifth being the personal savings, which was at an all-time low. The first big issue is around debt. The Federal Reserve has increased the federal funds rate 11 times, the fastest in the history of the United States. This has created all kinds of problems, specifically for the everyday consumer, in the form of credit cards, autos, student loans, and of course, mortgages. So anybody who has any kind of floating rate debt at all in these categories, and of course, there's more, they're getting squeezed financially no matter what's going on with inflation. As the Federal Reserve continues to raise rates, so will the rates rise on credit cards, autos, student loans, and of course on mortgages if they're not fixed. This is even more dangerous than inflation because if anybody has any of this kind of debt, the cost to service that debt is going up each and every month. This, unfortunately, is keeping the everyday person further and further away from even saving money and certainly further and further away from securing their financial futures. The second is with regard to equity. The best way to think about equity would be money that's sitting in your bank account that you're trying to invest. If you have money on the sidelines, which a lot of people do right now, and it's sitting in cash, you are now able to get 4 and 5% almost risk-free. This specifically is competing directly against the stock market, the bond market, real estate, commodities, and even investing in business. Why would you invest in something that's risky when you can have it sitting in a savings account or a 1-month T-bill at 4 or 5% almost risk-free? And so there's a lot of money sitting on the sidelines because it's just easier to park it risk-free. This will continue to be a problem for anyone that's trying to invest or even raise money in 2024. Problem number 2 is unemployment. So most of you might believe that low unemployment is good. However, from the Federal Reserve standpoint, low unemployment creates wage inflation. And inflation is exactly what the Federal Reserve is trying to combat, and they've been doing that through the increasing of the federal funds rate. And the statement here, the Federal Reserve Chairman Jerome Powell said it will be almost impossible for the central bank to beat inflation without hundreds of thousands of Americans losing their jobs. Federal officials expect the unemployment rate to rise to 4.4% next year, up from 3.7%, as they jack up borrowing costs and slow the economy, according to projections. Such an increase in the jobless rate over the course of a year would likely push more than 1 million workers out of their current jobs and leave millions more unable to find better work or higher wages. Powell said, "We certainly haven't given up on the idea that we can have a relatively modest increase in unemployment." Put simply, the Fed knows its past and its future rate hikes will lead to higher unemployment and will not stop fighting inflation because of it. Higher employment isn't just a side effect of the Fed's plans, it's one of their goals. In fact, the Federal Reserves themselves consider full employment to be right around 5%. So they're well below the mark, sitting at around 3.7, 3.8% today. If the Fed continues to push this agenda and people do lose their jobs, then there's going to be more and more people that can't pay their bills in the form of mortgages and in the form of rent. Number 3, the rise of the renter nation. Now, for many of you who've been watching my channel, you'll know that I did a whole video on renter nation about a year ago. What some of you might remember is in the mid-2000s, the home ownership rate was up over 69%. We were almost at 70%, which means that 69% of Americans owned homes and 31% rented. Since that time, we've actually slipped down to about a 65% home ownership and a 35% renter base. Now, why does that matter? What happens when millions of people move from home ownership to rentals? It puts tremendous affordability problems on the rental side of the equation, which is exactly what we've just seen. We've seen a dramatic rise in the price of rent in most U.S. markets over the last couple of years. This, my friends, is just the tip of the iceberg, because at the same time people are moving from home ownership to rentals, home builders, multifamily builders have pulled back because the cost to build and the interest rates on the cost to build have gone up so much that they put a lot of the construction projects that would have normally been supply on the shelf for now. And these are going to show up in 2025 and 2026 as even more severe shortages. So if you're a landlord, this is really good news. If you're a renter, this is not such good news. And what's going to happen is cities are going to start attacking the landlords in the form of rent control and rent caps. Number 4 has to do with debt maturities. So a lot of people that borrowed money in the last few years, it's now coming due either this year, next year, or the year after. On the top chart, you can see that there's over $1 trillion in U.S. commercial real estate that is maturing in 2023 and 2024. Unfortunately, the majority of this money is held in local and regional banks. So as these loans start to mature, the borrowers will be faced with either recapitalizing the loans or walking away from the real estate altogether, which is going to create massive disruption in the commercial lending market and the commercial real estate market. In addition to that, with the higher interest rates, we're seeing key consumer credit delinquency levels also rising, specifically in unsecured personal loans, credit cards, and autos. And autos currently are at a 26-year high for delinquencies. As of today, credit card debt has passed over $1 trillion. The point here is that a lot of people are heading toward a debt crisis that is unsustainable, especially with these interest rates continuing to rise or stay at what they are today. The 5th and final issue is that the real estate values are also down. So on the top right, you'll see the capitalization rate formula, which is simply net operating income over the market value of the asset determines the capitalization rate. What's happened is that the capitalization rates have actually gone up. The reason that they've gone up is because interest rates have gone up. There's an age-old argument, do rising interest rates affect capitalization rates directly? The answer is actually no. What it does do, however, is if a buyer is trying to solve to cash flow, they're going to offer less for a property than they would have in the prior year when rates were lower. Therefore, because of the lower prices, it's actually increasing the cap rates. In addition to that, most of these property operators are also suffering from lower NOIs or net operating income. Right below, you'll see that NOI is simply revenue minus expenses. At the same time where interest rates are higher and the cash flow is actually less, the NOI is also impacted due to the things like higher labor costs, higher material costs, higher insurance costs, higher utility costs, and higher property taxes. When expenses are going up, NOI is actually going down, which also makes the cap rates go up. What we're going to see here through 2024 is that cap rates are going to continue to creep up and valuations on properties are going to continue to creep down. How this could be a potential problem is if you have a loan maturing during next year and your property values are going down, the lender is now going to want you to recapitalize that, and you might not have any equity left in the property that you bought just 2 or 3 years ago. This could potentially create a whole other slew of property defaults, primarily on the commercial real estate side, that will make its way through the banking system and, of course, have the banks pull back again even more with lower loan to values and higher equity requirements